Becky, the markets are expecting some sort of policy stimulus from China now. We heard the repeated vows from Li Keqiang yesterday from the State Council meeting. What are you looking out for the most? What are the most likely concrete steps moving forward?
In the near term, we are looking for more monetary policy easing, including triple cut and possibly MLF cut in April as well. And on top of that, probably much more important is that when we look at the rhetorics of the recent statements, including the one released last night, that they are ready to go a lot more aggressive in terms of stimulating the economy in other fronts. One of the major fronts would be infrastructure. We have seen across the country identifying thousands and thousands of new infrastructure projects, and even for a city like Qingdao alone, launched more than 170 projects just yesterday. So we could expect a lot of the other measures, which are less relevant to the recent resurgence of COVID cases in China, to be boosting the economy using some other ways.
How concerned should we be, or the central bank be, about capital flight now? We saw those outflows in bonds in February. Are we likely to see that extend in March too, Becky?
We are expecting an acceleration of capital outflow in March. So based on our proprietary data, for example, by tracking the China bond dedicated ETF flows, together with the secondary bond trading information, our estimation is for the monthly outflow to be topping 100 billion CNY in March alone, which exceeds the previous record high of 80 billion just posted in February. And we are looking for capital outflow to continue in the second quarter on a combination of very fast convergence of CNY US dollar interest rate differential, a weakening growth outlook in China, and also tightening financial conditions elsewhere in the world.
Okay, now what does it mean for the currency? When you look at fundamentals, some of the premium and the attractiveness of the carry have certainly gone away. Becky, does the currency look a little bit too strong to you at this point?
Historically, the most reliable indicator for where dollar CNY goes is the interest rate differential. So this time around, we have seen on the front end of the U.S. Treasury curve now trading or yielding above CGBs nearly across the board. But dollar CNY has really moved very little. At this stage, how we view is that this is really fundamental flow-based result. That despite all the bad news in a combination of COVID outbreak, geopolitical tensions, much more hawkish Fed, and so on, we only seen dollar CNY moving from close to 630 to close to 640. So going forward in the foreseeable future, we feel that the capital outflows will continue to be mostly offset by the strong goods trade surplus inflows, and we are continuing to look for dollar CNY fairly stable in a range of 630 to 640. So if we are talking about a catalyst to drive this pair suddenly higher, most likely that would be the reopening of China's border, which will invite a lot of the pent-up demand for services trade outflows.
And do you have any idea when that might be?
When we talk about the reopening of the economy, or when we talk about the gradual walking away from this zero COVID policy, we think there would be two steps. The border reopening is more likely to be a 2023 story in our view, but we do expect the government to relax quite a bit of COVID containment controls, or at least introduce more effective or efficient way to contain the virus by the middle of this year to lead to less disruptive economic consequence.
Becky, maybe can you explain a little bit more why we are seeing this disconnect? You're talking about a renminbi that stayed pretty resilient amid the volatility we see in broader markets. We see CGBs continue to outperform as well. Why are we seeing these sort of record outflows? What do you think is driving that disconnect?
The record outflows comes from two fronts in our view. One is from investors. So this round is very different from the last round in 2015 to 16. In the last round, foreign investors really do not hold much liquid assets in China. So the bulk of capital outflows the last time around were coming from Chinese themselves. But this time around, foreign investors are already holding 8 trillions of onshore equities or bonds. They are very liquid assets. In theory, they could be taken out just overnight. So with some of the advantages, for example, including interest rate premium, growth premium, and so on, are now fading, then foreign investors would be adjusting their position on China exposure from overweight in the past back to neutral currently. The other part come from the corporates, which had been keeping some idle cash in China in CNY due to the strength of the currency and the interest rate premium. And now with the advantages fading, some of them would be reasonable to take out part of the idle cash from CNY and probably go back to dollar, which is now yielding even higher than CNY.
So, Becky, I can't remember then, to the point you just made, I can't remember the last time that, the paths of the PBOC and the Fed were this distinct, with the Fed obviously going to be aggressive on the other end. Do you think we will get a current account deficit in China this year?
The odds remains fairly low. Except for some short-term volatility when China just reopened its border, because the biggest deficit under China's current account comes from the services account deficit, including overseas tourism, study, and so on. So long as the border remains shut or largely shut, it's very hard to get a current account deficit in the foreseeable future. But having said that, it's indeed very rare to see PBOC and the Fed policy to go so opposite. The last time that we have only got one occasion was in June 1999, when the PBOC cut policy rate for the last time in that cycle and the Fed hike for the first time.